Hello, in this video, we'll continue our discussion about the analysis of business transactions with the help of T accounts. Just as a reminder, we discussed in part 1 that assets increase with debits, which are on the left side of a T account. A good way to remember might be that assets are also shown on the left side of the balance sheet. Every account has an increase side and a decrease side. Assets increase with the debit on the left side and decrease on the right side. Liabilities and owner's equity accounts increase with a credit on the right side. And another way to remember is that these accounts are listed on the left side of the balance sheet. Liabilities and owner's equity accounts decrease with a debit on the left side. Now, a few more reminders. Number 1, every transaction must have at least one debit and one credit. Number 2, the accounting equation must still be true after a transaction has been recorded, meaning total debits from all accounts must equal total credits from all accounts. And number 3, accountants use a trial balance to double check that all accounts still balance. We'll talk more about that once we've recorded the remainder of the 12 transactions for Eli's Consulting. We're now ready for the next 6 transactions, starting with the 7th transaction where the business earned $36,000 in revenue from clients who paid cash for bookkeeping, accounting, and consulting services. So it looks like our cash increased by $36,000. Cash is an asset, and assets increase with debits. And therefore, we're going to debit cash for $36,000. Our revenue increased as well. We're using the account fee income, and fee income is part of owner's equity, and owner's equity increases with credits. Therefore, fees income increases with a credit of $36,000. Eli's Consulting Services also earned $11,000 from various charge account clients. So in contrast to the prior transaction, we're not receiving cash, but we're receiving something almost as good as cash. It still is an asset, and it's called accounts receivable. Accounts receivable is an asset, and assets increase with debits, and therefore we're going to debit accounts receivable for $11,000 on the left side. Every accounting transaction must have at least one debit and one credit, and we just recorded our debit to accounts receivable, which means that we need to record the credit side for this transaction. In this transaction, we need to also record the increase in fees income, and just like we did for the last transaction, fees income increases with a credit of $11,000. For our 9th transaction, the company received $6,000 on account from clients who owed money for services previously billed. Basically, the clients who received services from Eli's Consulting for $11,000 previously, but did not pay cash, are now paying part of the amount. So 2 things are happening. Eli's Consulting's cash is increasing by $6,000, and accounts receivable are decreasing by $6,000. So we'll record a $6,000 debit to cash and a credit to accounts receivable for $6,000. In our 10th transaction, Eli's Consulting is paying $8,000 for salaries. There are 2 things that happened here. Salaries expenses increased and cash decreased. So let's start with the first part of our accounting transaction. Salaries expenses are part of owner's equity, and when salaries expenses increase, they decrease owner's equity. And owner's equity decreases with debits. Therefore, we need to debit salaries expenses for $8,000. As a reminder, all accounting transactions have at least one debit and one credit. And now that we've recorded the debit for this transaction, we need to record the credit. Eli's Consulting paid the salaries in cash, which means that cash decreased. Cash is an asset, and assets decrease with credits. Therefore, we credit cash for $8,000. Next, Eli's Consulting is paying utility expenses for $650. It's pretty much identical to the prior transaction, except that we're using a different expense account. But the concept is the same. Debit utility expenses for $650 and credit cash for $650. Our 12th transaction, Eli withdrew $5,000 in cash for personal expenses. It's important that it states personal expenses. That means not expenses of the business. And Train Eli is essentially just taking some of his investment back out of the company. So the company now owes him less money. Withdrawals are funds taken from the business by the owner for personal use. So let's analyze this transaction. Our cash decreases and owner's equity decreases. So we know that a decrease of cash is recorded by entering a credit into the cash account of $5,000. Now that we know the credit for this transaction, we're looking for the debit. Our owner's equity is decreasing, and for the owner's withdrawals, we use a special account called Trade and Eli Drawing. Why don't we just use the capital account? Well, when we prepare the statement of owner's equity, we'll need to list the owner's withdrawals on a separate line, and that's a lot easier when we're tracking the withdrawals in a separate account. So let's debit Trade and Eli's drawing account for $5,000 for debit. Again, we'll foot and sum all our T accounts. First on the asset side, then for the liabilities, and then for the owner's equity accounts. And we're now ready to move on to our trial balance. What's the trial balance, and why do we prepare a trial balance? It's a quick overview of our account balances and our T accounts into which we've recorded our business transactions. The trial balance is a statement that tests the accuracy of total debits and credits after transactions have been recorded. Sometimes, though, the trial balance does not balance. What do you do in that case? Here are a few tips for finding what transactions you might have recorded incorrectly. If the difference between debits and credits can be divided by 9, there is a transposition error, like for instance 45 or 54. So if the difference between debits and your credits is divisible by 9, that means you've transposed something. Meaning, for instance, you entered $3,500 on the debit side and $5,300 on the credit side. The difference between $5,300 and $3,500 is $1,800, which is divisible by 9, and that would therefore be a transposition error. A slide occurs when the decimal point is misplaced. So you've entered one side as $375 and the other one is $37.50. Those are the typical errors that you might find. Other errors would be, for instance, you recorded a debit, but you forgot to record the credit. That's typical as well. That is why after the trial balance has been prepared, we double check that the total debits equal the total credits. We're now ready to prepare the financial statements, so don't forget that important step. Double check that your debits equal your credits. So what financial statement do we prepare first? It's always the income statement that comes first. Why? As a reminder, you need the net income from the income statement to complete the owner's equity, right? You can't prepare the statement of owner's equity if you don't have the net income. And you can't complete the balance sheet without knowing the ending balance for the owner's equity. So it's important that you have that. So let's start with the income statement. We go back to our trial balance and we enter the fee income from our trial balance into the income statement for $47,000. We enter the expenses for salaries, expenses, and utility expenses for a total of $8,650. We then subtract the expenses from the revenue and come up with net income of $38,350. We're going to need the net income when we prepare the statement of owner's equity next. Okay, we start with a beginning balance of capital. As of December 1st, we have $100,000. We add that to our net income of $38,350 from the income statement, and we subtract what Trayton Eli already took out as drawings. We then combine the net income less the withdrawals and then add that amount to the beginning balance, coming up with an ending capital balance of $133,350. We're now ready to prepare the balance sheet. On the left side of the balance sheet, we list all of our assets, cash, accounts receivable, supplies, prepaid rent, and equipment, for a total of $136,850. And we list our liabilities on the right side, starting with accounts payable, $3,500. We then list owner's equity, another form of liability that the business has. And we enter Trayton Eli's ending capital balance, the $133,350, which we got from the owner's equity, for a total of $136,850. And we again see that our accounting equation of assets equals liabilities and owner's equity still holds true. $136,850 on one side and $136,850 on the other side. I hope this was helpful. Keep practicing and don't hesitate to reach out if you have any questions.